welcome to another episode at Educate to Trade on a Monday with me, Zee.
And Ikjot, happy Monday. Welcome back.
How's it going, Ikjot?
Doing really well.
It's been a while since we've done this. It's been a few months, huh?
It has, yeah. It's always Chris usually.
Yeah.
Very rare. Quite good to change the script a little because we had to wait all the way till Friday to how you decided.
Yeah, I'm pretty enjoying your insights. I mean, you first interviewed Chris and got his sort of insights of how he trades and stuff. And maybe today could be that kind of episode. You can ask me about my strategies and what the market sort of bringing on to us this week.
Possibly, yeah. There's a lot that happened after. Pretty exciting. To what happened. I do have my list of questions to ask you today.
Sure.
So I'm not going to waste anyone's time, not even yours. I'm going to ask you questions straight away. So first things first, right? So with CPI unemployment claims dropping this week, what specific numbers are you watching, and how quickly could we pivot if the data comes out or cooler?
I think last week it kind of shocked the system when we had sort of the numbers come in the way they did. And I think this week we might see more neutral numbers. We won't see sort of big movements as we did last week. I think last week there was a few shocks to the market when we had sort of, I think, 10,000 job sort of claims in that sort of month. We were predicting 100,000+ and it came down to 10,000. So that does impact the market. I don't think it will impact it as heavy as it did. I think this is going to be a much slower week. But we do have CPI coming up on Tuesday, and then we do have unemployment claim numbers coming on Thursday, 1:30 p.m. UK time. So we are going to look forward to that. Yeah, I'm looking for mutual figures. Yeah, that's what we're looking for. So US CPI on Tuesday, and then we'll have unemployment claims on Thursday.
Right. So recently, I've started looking into. I know the whole trading industry. These candlesticks. So I just realized that today's price action is literally price opening today this week going a little bit higher, and now it's just not moving at all.
Yeah.
So I think for the following days, I personally have bearish price numbers.
Yeah.
Price open up, went up a little bit. Now, as candlesticks formation says, it should be open, high, low, and close.
Yeah.
So I personally would be looking for some bearish sets. But anyway, the thing with trading is nothing guaranteed. You can't really tell exactly or predict the markets. You just got to react to if and when the data comes out. Yeah, that's our verdict on CPI and on figure this week. So
awesome.
Moving on to the next question. What I have for you is about crypto.
Okay.
Right. So since you're one of the biggest advocate of crypto that I've ever met, what we'd like to ask you today is, so everyone's talking about the next crypto bull run, but are we seeing any real institutional flows in crypto, or is it just retail fear of missing out drawing prices? So what's your take on crypto?
Yeah, my take on crypto is something I'd like to kind of introduce to traders here, and I think it's something that we should do more of. Now we have AI, we have things like GPT-5 that came out last week. So I've been using GPT-5 quite a bit for analytics work. So I did something really interesting this week, and I asked GPT point blank, how much BTC has been accumulated by institutes to cause the pump we currently see in the market? So I want to know how much has been accumulated. Because last year, I think institutes only held about 3 to 4% of Bitcoin supply. What GPT tells us is pretty interesting. It tells us that 20% of market supply of Bitcoin currently is owned by the institutes. And in the last 6 months, they've accumulated almost 11%. Every 6 months, they buy the dips and then they hold it onto their ETFs in their portfolio. So it tells me that the institutes are starting to be bullish about it. But something else happened in crypto this week. You know what happened this week? Ethereum. Right? So that's the second thing I did this week. I go to GPT and I ask it, how much has been accumulated in Ethereum by the institutes? And it's pretty interesting. They've started to hold quite a bit. I mean, I asked this question about 3 years ago, and I got 5% on Bitcoin, and then they started to accumulate quite a bit. This year alone, 6 million Ethereums have been accumulated. 5% of supply is currently held by institutes. This is why we saw the pump this week. So if you see price right now, Ethereum passed the price of 4,000, and currently we're at about 4,100, 4,200 sort of range in there. And then the all-time high is 4,800. So that's my sort of insights now to see if institutes buy any of these dips to take it across there. But yeah, institutes have been accumulating a bunch. If we look into the crypto market cap right now, it's sitting at $4 trillion. Us as sort of crypto sort of folks who are sort of fanatical about it, we know outside the $4 trillion, there's about $400 trillion of liquidity just waiting in real estate, in institutional money. Now, when does that enter crypto? It's starting to do it small steps right now. I think Bitcoin, I think they're 20% in. I think they're 5% in on Ethereum. And I wonder what they're going to do with the other ones like Solana, USDC, USDT, and the other ones. So I'm pretty excited about that.
Are you sure it's all institutions and not you?
Institutes are able to sort of accumulate $1.5 billion worth of Ethereum. I don't think I can do that, even if I had $1 billion.
I think you're just hiding the fact that you have been holding crypto since it started existing. You are Satoshi, not.
I could be accumulating. I could have launched the proof of work contract for sure.
Yeah, well, be very, very guys. He's very big on crypto, and I do have a feeling that
Sure.
it is not a made up name. I think I have actually watched not watched a documentary, but read a paper on an actual guy, which someone has actually done his own research, and they have come to the conclusion that he himself. He's an American blogger. But we'll see, because he always started talking about how money, and then all the dates of actually his birthdays and his family's birthdays. Well, it's all conspiracy theory, but I think it's quite interesting to look into once in a while.
It's pretty interesting that we speculate about a person that we don't know nothing about, but we do speculate that he was British from his emails. We do, because Satoshi was writing things in sort of, you can say, European context. So he was writing color in COLOUR. So we do speculate that he's British. We do speculate that he speaks good English. We still don't know who he is, where he's from, but he moves the markets. We all talk about him. He's the peg right now in crypto. And yeah, the market cap of Bitcoin is starting to become more institutionalized. So
yeah,
we're learning a lot from that.
Yeah, I think the time is taken for retail.
Now, what retail are sort of asking, are we in the bull market yet? Are we in the bull market? So this is something I want to kind of go into right now. So if we look into the charts here, there's a chart called Bitcoin dominance. So normally what happens is when we see Bitcoin fall, you can say Bitcoin dominance fall below 50%, what we normally see is a bull market sort of coming. Right now, we're starting to slowly see that. We're starting to see Bitcoin sort of go from the 61, 62% where it's been dominating for a while, right? It's been dominating for a while. We're starting to see it lose its sort of dominance there. So we're at 60% now. For retail to start taking interest in sort of crypto, they want to see Bitcoin dominance below 50%. And then we're really in bull market. But I think we could be very close to it right now.
And you spoke about Ethereum and what I did last week. Would you feel that the levels that it's reached now they would hold, or would you think since it went to a high now it's time to just take profits and get out of the market?
I think what we normally see happen in markets, right? Whenever we make a high on Ethereum or Bitcoin, stuff, we see a bit of consolidation. So we see so as you say, candlesticks. We see boring candlesticks, small spikes. We consolidate unless the institute's going to buy that floor. We might see a pullback. I think I'm predicting it's going to be a boring few weeks now because we've hit all-time highs on Bitcoin. We've hit all-time highs on Ethereum. I think September is going to be a boring week because we're leading to the interest rate decision, right? Powell. So 30th of this month, of September, Powell is going to kind of give us a hint of if they're going to lower interest rates. And I think if interest rates lower down, then we might see a bull market. Then we might see Ethereum really go up. So yeah, we're all anticipating. I mean, we do speculate that.
Yeah, I do feel that this time we might see some cuts. Reason being is that they've been holding on for far too long. They wanted to cut rates at the start of the year and they didn't really do anything about it. And then now I think if Powell doesn't do it, Trump himself will just drag him out of his office and just make him actually cut rates this time.
Yeah, everyone's anticipating it. I think when I was speaking to Chris about it last week, he predicted 85% of the market predict that there's going to be a cut in interest rates. Now, me and sort of Chris looked into this, and for us to see lower interest rates, we need to see a hit at equities. We need to see hits on indices. We need to see S&P down. We need to see Nasdaq down. We need to see assets down, because that's when you bring lower interest rates. We have to show that the market is weak. Powell's sort of you can say debate right now with Trump is we have a strong economy. S&P is hitting all-time highs. Nasdaq is at all-time highs. Why should we lower interest rates? So I think that's the sort of debate. But I predict that we might see lower interest rates in the next month or so.
Makes sense. Well, there's also one thing about these financial markets is whatever the majority is thinking, it actually tends to do the opposite. I'm not saying it's guaranteed, but we've seen time and time again, like all the numbers add up, all the the clues are adding up. However, we could also see them increasing rates.
Yeah.
Just because they always tend to do the opposite, don't they? So we'll see how that one goes. Because if price keeps going up and up and up, they would have to somehow control the inflation, right? So then that means they're increasing interest rates.
Who knows? Or he might just keep the way it is.
Yeah, just steady.
If he keeps it steady, then markets will move.
Yeah. So I think all eyes will then just continue to be on crypto then.
Because for crypto to really rally, we need lower interest rates, because when you lower interest rates, people take risk, right? Right now, people are playing it safe. People think we're at tops. When we're at tops, we don't take the risks that we do. We need to see dips. We need to see interest rates lower down. Then comes the retail market. Then comes the marketing. Then you get those emails, buy some Bitcoin.
yeah, pretty much, yeah. And there's one market that is no one really talks about and is very under the radar for most retail traders, I would say, because it's quite huge in institutional, the institution side of the spectrum, which is the bond market.
Oh yes.
So let's talk about the massive treasury trade that sent yields spiking, and what do you think was behind it? Was it a major institution repositioning, or could this just signal something bigger about Fed policy expectations?
This was quite big, so I'm going to kind of show it to you on the chart. So this happened on Friday. It happened just a few hours before the New York Open. One trader sort of sold off 80,000 contracts in treasury yields.
Wow.
And he sold it off. Like normally institutes are supposed to iceberg their way into a position. This lad went in 80,000 deep and he sold thing, because this spike happened within 5 minutes, right? We went from 4.25% to 4.28%. And everyone thought it was so what happens is normally when you throw an order like that, he starts to move the market because everyone follows suit now. So when he made this thing happen in 5 minutes, everyone started to do the same, and everyone sort of rushed the market. And in fact, what it did was it took, you can say, the interest rate, it took the bonds up to 4.28% for the day. And we thought from here we should see shorts on S&P, we should see shorts on Nasdaq. The opposite happened. Everything rallied. So this is how our sort of Friday looked, right? So Friday came in, and right, we rallied quite a bit by I think 200-300 points. I think S&P was up a few percent, Nasdaq was up, and that's what this spoofer did. It's quite big. It made headlines. Like this is Reuters news here. And it's pretty interesting. I also went into GBT and I asked it that similar question. I'm like, what rose the market? So they wrote fact, right? On August the 7th, a sudden spike, roughly 6 basis points jump in minutes, was traced to appear to be oversized, right? Is an oversized position. 8,000 contracts were misexecuted. It's like he pressed the red button. by accident. So this was quite big.
I kind of felt it.
Everyone felt it.
Yeah.
Because everyone was sort of looking for shorts. I think I was sort of gossiping with you and others that this could really short from here, but instead we finished at all-time highs.
Yeah, I think that was a good Friday for most of us.
Yeah,
because we do trade in New York session, so I think it was kind of a good Friday.
Yeah, so if you were trading S&P at New York session, right? You open this trade here, you're up 64 points in 5 minutes.
Where else does a man won on a Friday?
Well, more, it's a good way to end. But it was a big thing, and these things happen once in a while. They don't happen all the time, but they do happen.
But like, how do you see these stories connect? Because we just spoke about interest rate decisions, and now we spoke about bonds and how what a mistake that happened in the markets. So are you considering like the yields are going to continue to rise and it's going to be bullish for crypto to in the future, or what does it tell us about smart money positioning the investments?
What I sort of think is like we look at the fun stuff, so we look into futures, we look into price action on the dollar index, we look into all these different things. But one thing we know personally is everyone has an overdraft account. People take loans, we take credit cards, we borrow quite a bit. So these economies do the same thing. They borrow in huge amounts. And depending on how they sell their bonds, so bond is sort of their version of a credit card. If they're not able to sell the credit card, they're not able to trade. You know how much we're in debt right now in the US right now?
6 trillion?
No, $37 trillion. Right? So it's $37 trillion.
Who do they even owe this money to?
The Federal Reserve and the Bank of China and the Europeans.
Wow, 36 trillion.
37 now. We're tapping 37. So 37 trillion. And it's not just the US. If you see the world economies and you put them together, we're $200 trillion in debt.
To who?
Right? To who?
Yeah. So
for us to spend $1, a pound, a note, right? We have to first send tender to borrow.
Oh yeah.
Right? So we borrow to spend. And this has been our economy for the past sort of 200-300 years. And I think the bond market is something to really look into. I think it's something that I've started to really be intrigued. I mean, I've been trading indices in crypto for quite a bit, but I think the last 3 months I've been really understanding the bond market and how sort of we borrow.
Yeah. I literally asked this question to Chris when I last spoke to him on Friday on a podcast as well. So I asked him if there was one market that you would want people to look into, which one would it be? And I don't want a typical answer like it's crypto. So he definitely did say that it got to be bond market.
Yeah.
So I think there was some substance into it, and people should start looking into it more than they look at, I don't know, what's the cool kid in the financial market? I think it's gold. Everyone loves looking at gold.
Oh yeah.
I think if you start looking into bond markets, it might just help you loads, in my opinion.
It sets perspectives. When I first started to understand US equity companies like Apple and stuff, I would wait for those Apple presentations, right? Looking for the iOS, and then you would look at the market price and you think it would long, right? You think it'd be a good long, but then it would eventually short. And what you find is Apple borrows a ton of money. And then when they don't market a product that's not a big improvement from the previous iPhone, then markets fall. And I think that's when I started to understand borrowing. Now the crazy thing is, in Japan, no company has any borrowing because they went through a market crash. And this happens here. The 2008 sort of recession that happened here and the flash crash that happened before, it was all interlinked with borrowing and bonds. So I think for new traders, coming to Educate to Trade, taking up our Telegram groups, they should start to understand US 10-year Treasury reserves. They should understand the German bonds. They should understand these asset classes because they move the markets. They're the silent ones in the background.
Yeah, absolutely. And these are just the non-fancy ones, as I would like to say to them, because it doesn't appeal as much as gold moving 100 ticks in a day and so on and so forth. But again, this is what actually tells you the real story, because if it wasn't for bonds and yields, you will never know what US currency is standing for. And if you don't know about US currency, how are you ever going to look into crypto?
Yeah.
So I think bonds and yields is where people should really and truly start from to then base the decisions off, not just DXY.
I think the issue is when we look at assets and we look at them and their behaviors, we think they're mutually independent.
Yeah.
But the truth is they are interdependent. They all interdepend. One thing moves the other. It's like a domino effect, right? So if one domino moves, it sort of leads on to the other dominoes falling as well. So I think the same thing with bonds and sort of currencies. It's something that most traders to start to look into, especially with where we're going right now, right? We are looking for lower interest rates. We're in a few different war zones, right? The Ukraine conflict, the Israel sort of thing. All these things are connected to borrowing and bonds because what happens with the US aid? These countries ask for it. So I think there's a huge interlink between bond rates and what happens with the world.
I think that's a really good way to put this into perspective. Because again, when we do give them the aid, it's actually them borrowing from us. I mean, not from us because we live in the UK, but from the US. So yeah, I think that is a lot that we have spoken on bonds today. So now I would like to move on to something else. So for viewers watching this today, trying to navigate all this volatility, now whether they are day trading or just managing their portfolios, what's one key level or data point they should be watching this week?
This week, they should look at consolidation on the US indices. I think this is going to be really interesting to see how long do we consolidate at the top. And that's one thing. I think, especially with sort of the Treasury yields going up, we should look at the dollar index. Look at this. This happened on Friday. Spoof, right? It's spoofed to 99. So the dollar index. Remember, it's a divergence. When you're trading, you should always look at indicators that are at the opposite ranges of each other. So the dollar index, S&P 500, and things like gold can also be used. But for me, it's S&P because I'm looking at consolidation.
Yeah, fair enough. And we already have spoken about the guy that moved the S&P.
Yeah.
Do you want to speak a little bit more about, was it just because of him the S&P moved on Friday, or were there any other factors that contributed to S&P and Nasdaq moving and making all-time highs on Friday last week?
I think, as I said, I used the word domino effect. So this lad here who sold 8,000 contracts and made this thing spike by 2%, he sent a rally call. Like he did that, and once bonds went up, everyone was anticipating. We were all anticipating as traders for shorts on a Friday because that's what happened last Friday. But it's a domino effect. So that trader led to more people taking up longer positions on Nasdaq, right? Because when borrowings are sold, then it rallies the assets, the riskier assets. So it had a domino effect. But there was other things that I mean it wasn't just that trader. It was many things last week. It was sort of the unemployment claim numbers. It was a few different things that we started to see. We started to speculate lower interest rates. So a bunch of rallies, but he did spike, and we get this once in a blue moon. It's like a shooting star in the skies. We don't see it often, but when we do, it rallies the market.
Yeah, and then when we do see these things, we're just not prepared to take advantage of it.
No.
Because it always usually tends to happen on the days when no one really wants to pay attention to the markets, like on a Friday.
Yeah, on a Friday, that's when you sort of least expect such huge movements. But that's why we chart. That's why we create alerts. That's why we educate folks here to do their charting, to understand their technicals, to understand the depth of the fundamentals. Right now, Trump is speaking, right? What could he be speaking about? Like we know Trump's sort of Twitter handle and his sort of True Social post is something me and Chris follow every single day of the week. So when he speaks, he moves markets. So there's all these different fundamental parts that sort of trigger price action. So we anticipate things, we create alerts, we plan that. That's why we get people here looking at our Telegram group, looking into what we sell here at Educate to Trade, so we can be prepared for these kind of moves. Because at the end of the day, they're just levels being hit. It's not like rocket science, right? For this long to happen, it just hit a previous level in the long spectrum of things. So if you are a trader, you're able to create a horizontal line like this and be able to anticipate a move like that. So it's all down to anticipation and planning for those things as a trader.
Fair enough. Right, so I'm almost at the end of asking you question related to trading. But what I also want to know now is what have you personally been up to? Because as I know you have started getting into vibe coding, and GPT-5 just came out last week. So what have you been up to then?
I think the future of us traders is we're not going to be manually doing things as much. I think we're going to be operating bots, and I think the markets, as much as the algo's taken over, and the more I see. So I was at Google a couple of weeks ago, and I started to meet some startups, and I started to meet traders. And what we were showed about we were given a little demo of what the supercomputer can do. And I'm telling you right now, you need to start to not just trade and manually trade. You need to start operating algos. You need to create bots, and that's what I've been doing. I've been training using Cursor and GPT-5. I've been training bots to trade the way I do, look into smart money moves, see how I sort of short into the market, how I look for bullish engulfing patterns, how I look at fundamentals. The more I feed it, the more it sort of creates these scripts for me in trading, in PineScript and in MetaTrader and all these different platforms. So that's my next sort of move. I think we're going to move from being traders into becoming operators of these things, because the markets are going to start to move fast. So that's something that's enticing me. It's something I spend all night with this coding.
And you know, Russ asked me this exact, I mean, not this, but Russ asked me a question last week regarding artificial intelligence and coding and so forth. And I think all traders who are, I would say, you know, have been in the markets for more than 5 years or so, I think we all agree on this now, that the world is moving rapidly, and us as traders, I think we now have, you know, quite a good opportunity to leverage something that we couldn't 5-10 years ago. And it's available to all of us now because of AI. 5, 6, 7 years ago, you had to have all the knowledge in the world to do with coding in order to build an algo, and it was a very high paying job. But I think because of AI now, it's just like anyone could do it as long as they understand what they're working with. I mean, it doesn't take, you know, a lot of brain cells or genius to actually build an algo in this day and age, does it?
No, so compare this to like 6 years ago, where a newer trader paid an SQL developer about £11,000 to create a data set just for trades he's taken. So just a data sheet, a spreadsheet. Now you can sort of type that sentence in with the right prompt, and it starts to build the spreadsheet for you, creates the dashboard, it creates the XP points, it creates all these sort of levels to it. It can be done in a matter of minutes, and then you can deploy a contract or deploy an application within a matter of a few days. So I think it's like moving from horses, right? We used to saddle horses and go on long travels. Then we got into the cars, right? The Ford. I think we're doing the same thing here. I think we're moving into an unknown territory, hopefully beneficial to us, but we do have to prepare. We have to move away from saddling the horse. We need to learn how to navigate the manual sort of triggers on the car.
Absolutely, yes, because I was about to say this as well. Like, even though it sounds like, okay, AI is going to solve all our trading problems, but however, you still got to be smart enough to know when it does make a mistake and how to actually correct it. So there's still quite a lot of learning to do, and I think now is the correct time to go through that learning curve to get to a stage where you're not just manually trading yourself, and you also have an algo that copies and does the exact same thing as you do. Because there will be days when you don't feel like trading, and there will be days when you miss out on a trade, but an algo wouldn't.
I heard a statistic that I think a quant sort of page came out in a big university in America, and it said that 20% of all trades that take place right now are quantitative, are algo defined, and they predict over the next sort of not 10 years, not 5 to 10 years, not a decade from now, but actually 2-3 years from now, that it'll be 40%, 50%. So I think we should start to move into that, and that's what I've been doing.
Fair enough. I think there will be a time when it will just be quant hedge funds versus quant hedge funds. It's just algos versus algos.
You see how we see GPT go against Claude and Claude go against Gemini, and how we see this sort of battle for data right now. We're going to see the same thing between big institutes and hedge funds. I think it's going to be quant v quant for sure.
Yeah, I personally see that happening myself. But with that being said, you know, I've had a really fun time today with you, Zee.
Always.
You know, it's a pleasure to always jump on a podcast with you, even though it happens very rarely nowadays. But thank you so much for today, and we will see you guys in the next podcast. Any other final remarks from your side?
Yeah, do your research, understand fundamentals, and enjoy your Fridays. The weather's really good. I'll be surfing.
You will be surfing.
Yes, sir.
He's not just catching waves in crypto; he's catching waves in real life as well.
Yeah, we go to Cornwall and we do catch them there. Yeah, every weekend. Thank you.
Fair enough. Thank you.